Okay, we're live. 7:52. Okay, we're on live now. I hope everybody can listen to me for those who just joined. So yeah, so as usual, we are going to start at 8 o'clock. So that we'll wait for the rest to actually join us. Yeah, Ocean Hunter just joined us. Yeah, welcome on. Welcome all. Okay. Oh, hi, Rosum. Hi. Yeah, good to see you again. Good to see you again. How's your trading journey for the recent market? Like, you receive my message? Yeah, we do receive your message in the live section. Or you mean somewhere else? I think Option Hunter says that you're actually welcome to actually message us. But we did see your post as well. We really appreciates what you have shared. It's really amazing reviews. So how's your trading journey? Yeah, I mean, will be going to the Move Fair Singapore. So sure whether you are coming. Still waiting for another spread to close. Yeah, I hope it's a profit one. But if it's not, then it's fine as well. It's part of the process. Yeah, Option Hunter asking you whether you are in Singapore or Malaysia. So I think, so I think you'll be from in Singapore. So you actually can when go visit the Bull Fest Singapore to meet or win. So I'm not going this time. So Owen will be there. Yeah, Owen will be there. Yeah. Owen will be there. So I'm not going. So like, yeah. I'm not going to Singapore Move Fest. Owen will be going because having some other project to be to be conducted. One in Malaysia, one in Singapore. So yeah, I wish I could visit as well, but yeah, sadly. But that definitely will get the chance to be involved if. So yeah, we still have 4 minutes to go, and so we'll wait the rest for to join. And as you guys like might be aware, right? Like, the option playbook series has almost come to an end. Like today's chapter is what, like chapter 9, right? So yeah, yeah, it's kind of sad, yeah. But yeah, but what makes me really like grateful is that you guys have been really really knows where is the option trading's directions going coming from, like the way how you actually approach the market, and then how you actually can use the options under different kind of situations. So yeah, enjoying trade. Is there a way to review the previous session? Yes. You can actually visit our pages, and then you can tap on the live, and then there will be like few previous sections to actually for you to replay it. You can replay as much as you want. I'm enjoying trading option. Yeah. Glad that you enjoy. Yeah, really glad that you enjoy. I'm a beginner to option. Yeah, no worries because like today's session is kind of like uh I would say I will talk a little bit some advanced thing, but if you really want to start from ground and then go back to the basic, you always can visit our page and then go to the live sections there, live tab there. You can see all the previous recorded is in this page like option under pages. Not sure whether I can get this. Hold on a second. Which pages? Okay. Okay, so you guys can see my pages, right? So that within this option playbook pages, so you can actually go to the live, and then you can see there's previous sessions like I did mentions about the debit spread. There's a chapter 7, 6, and 5, 4, 3, 2, 1. Yeah, that basically is like the whole section you may want to watch. Like, you can watch as much as you want. You know? I hope you do know how to actually visit the pages. If not, then by the end of these sections, I'll be sharing the QR code for you to actually scan it as well. You can actually use the Moomoo apps to actually scan the QR code to visit these pages. We are using this account to actually conduct live, by the way. Yeah. So yeah, for those who actually is like keen into meet Alwyn, like he will be speaking at 3:50 and 5:20 at UFEF Singapore. So yeah, feel free to pay a visit if you do have some time, like we could like you guys could actually like um meet up in real like I mean like we're considered like online friends right now is maybe it's an opportunity for you guys to meet offline. So make sure you guys pay a visit to meet Owen. You know. Right. Okay. So we are going to. It's already 8 o'clock. Okay. So we are going to start our sections. Oh, I missed a fly like eagle. Hi. Hi eagle. Okay. So I'm going to start my section now since it's 8 o'clock. So you guys know that as usual, like my sessions will always start from the disclaimer because like I always want you guys to actually be aware that like option two entail a significant risk if you are not knowing what you are doing. So you the avoid it and then start learning first, and then be make sure that you actually read all the disclaimer and then put it in put it in your minds of it, and then make sure you also read the risk, the characteristic and risk of standardized options before engaging in any option strategy. So that make sure you be aware of that. Okay, so yeah, so we are going to start our sections. In today's sections, right? I'm going to start with something that really goes back to the basics like at the beginning of the times like I did explain like what is the options, those kind of the premium and extrinsic value, intrinsic value, all those kind of things, right? The buyer and the seller, and then we straight go into the wheel strategy, those kind of spread things, right? So when it comes back to the long this section, big moves with the small capital, basically is like a long call long put, right? you know, long call, long put. So you guys, I forgot to change the, you know, change the title for the subtitle here. But basically, I'm going to teach like a long call, long put. I just want to have a quick questions. Like, do you guys know why I'm putting this section on the last? This is the last strategy I'm going to teach. The long call, long put. Do you guys know why I'm putting this chapter at the last session as the last session? Can anybody answer me? Like, if you would like to make a guess, you know? Just curious. Okay. Yes, yes, more risky, low probability. Yeah, that's true. It's true. And then um it's the most simple thing, but it is also one of the strategies that is most easy to lose money. Okay, most easy to lose money. So because like a lot of people like when it comes into the options field, they tends to like just long call and long puts, right? And then what they long, and they long the shorter expiration because it's cheap. They tends to like betting on those kind of directions. So but they are not aware what are those kind of risks coming at him or her, you know. So in today's sessions, I'm going to talk not only tell you guys like what is a long call long put. I think you guys already know what is a long call long put. But I'm going to give you guys some of the context, what you should be aware before you're doing this kind of strategies. Okay. So if you guys are ready, then I'll be starting. Okay. So as always, if you guys do like have my books, I love the analogies of the booking fees. My co-author have me have written this like paying it for the opportunity. So you need to think of it like a long option is like a non-refundable booking fees. You pay a premium to reserve the rights, and then you act on later. So if the condition move in your favor, the value can be increased. If nothing happen, your risk is basically defined. So the maximum risk you can lose is just the premium that you have paid. You know, so that long call basically there's three things we only need to focus. Like the first thing is the premium, which is the booking fees that you have paid, and then the payoff. Like if let's say the directions is if the direction is really move in your favor, then your returns could be amplified. Okay. And then the third things is we knows that the options is can be like it decays every single day. Okay. Because of the probability things. Okay. So that's the third things we know. And then also we know that's the why some of the people love to long the options instead of the trading the stock. It's not like saying the stock is not good. Okay, it's just because of the leverage. Like for example, it's like you may need a 50,000 to actually trade 100 shares. So there's a massive capital lockup, right? But in options, most likely you will be just paying like 1,000, 2,000, or 3,000 but you're holding the same exact 100 shares of to ride the momentum. Okay, leverage is the first thing. Okay, and the second thing is that when it gaps 20%, like for example, it's like if you buy the stock, if it gaps down for another 20% overnight, so the capital loss is really painful. But if let's say in options, even though it's gapped 20%, the maximum risk you can lose is only the premium that you have paid. Okay, so we already know that because we are buyers, so that we have limited risk. And then the capital intense I mentioned already, and then but this one is exploring ROI. I think you guys might get the ideas already. When the stock like move like 5%, your options can explode in terms of your ROI like 100%, 200%, 300%, or even 1,000%. It can happen. It can happen. That's the power of the options, and that's what the most people chasing it for. Okay, but so that we already knows that the benefits, right, and the defined risk and the unlimited profit. So who should actually consider this strategy? So basically, I would say it's like for the aggressive speculators. Okay, so as usual, we'll see like whether there's a four parts we will be covering. It's like the first things of course, is the capital requirements. Like capital requirements is just like relatively low if you compare to the stock trading, not to the debit spread. Of course, the debit spread will be much more lower than the long calls. But if you're comparing it to the stock trading, your capital requirement is relatively low. Okay, and also the risk profile, I think, will be high. Okay, even though your capital is low, but because you're long call, your loss, even though your loss is capped, but it also means that if you lose 100% of the premium that you have paid. Okay, you just have to accept. If let's say you keep on getting it wrong, then you just have to accept the losses. Okay, and then also like what is the objective is to actually capture the breakout, and then those kind of a breakout you want is something like you expecting the price is like explode. It's not like slow bull or my sideway then it goes up. No, you want it like move very fast, those kind of a momentum. Okay. So you want this kind of a breakout. And then also typically like because you're long call and long put, and then typically you will be like trading at a very short term perspective, at a very shorter terms. But in long call, we already know that you actually can long like longer expirations or even like long term leaps, right? We already covered that chapter. So that, but in terms of just like long call, typically people will just go for like weeks or months to actually trade the breakout. Okay, but of course you need to be aware of the risk of the time decay, all those kind of things. Okay, later I'll cover that. And then when to use this strategy is that when you are aggressively bullish, okay, like buying a call, or maybe you are aggressively bearish, and then you buy a put, okay, so that you guys have to like take my words carefully. I mean like aggressively. It's a really strong bull. Okay, the magnitude could be very very big, and then the breakout market, and then also you want to, because you are not doing a spread, so that you just buy a call, so that when you buy a call, you wish you as a buyer, you want the options to be cheap or like expensive. Can anybody tell me? Okay, just for some interaction, because today's session is going to be a very quick one, so that I need some interactions. I have more time to actually interact with you guys. You know, do you guys, if you long a call, do you guys want the or if you want it expensive when before you buy, or bro, before you buy, you want to buy something. When you buy things, you want to buy cheap or expensive? Yeah, cheap, right? You want to buy it cheap, and then it become expensive, then you sell it later, right? Yeah, cheap. So so that in this case, it's very important for you to actually identify whether your current options IV is relatively high or low. If your options is the environments and the IV is very high, likely your options is option premium has been elevated. Remembers the extrinsic value. Extrinsic value has two things, right? One is the time value. Another thing is what? Another thing is what? Okay, this is the second question. Another thing is what? Please answer in the comment sections, so that you already at the chapter 9. I hope you guys do know what is the extrinsic value. One is the time value, another one is what? Okay, let me see. Let me see the comment sections. Oh, I think some of the guys didn't attend my chapter. Okay. Rosum got it right. Yes. Implied volatility. Okay, IV. So that volatility and time value equal to extrinsic value. So that when the IV is high, it also means that your premium likely elevated. Yes. So remember this. This is the chapter 2. I think chapter 2 that we are already covered. Okay, if you guys didn't watch it, make sure you guys watch the replay. This is why it's very important to actually put this chapter at the end so that I can catch you guys whether your base foundation and basics is still there or not. Yeah. Okay. So you want to buy the options at the very during the IV is low, because like you don't want to buy at the expensive prices. But because like assume that if let's say the the volatility is very high and then you still buy the options, you have to fight more things, because like when the IV it revert, because we know that the IV won't be like elevated for forever, right? It will be like mean reverts, right? When the IV reverse, likely your premium will be reduced as well. So that's where your enemy is. If you long options, your option depreciate faster because of time because of what? Because the time is slowly eat your premium, and also like the IV goes down, your option premium will goes down as well. Okay, your extrinsic, the overall it's just like your extrinsic value problem. Okay, everything will be just going down, right? Okay, why this strategy works? Okay, is risk and reward. Okay, because like you can use a relatively low capital to actually tap into this market and then amplify the return. Okay, and then also it gave you the high leverage, because like compared to just now I gave you the examples, like compare with the stock trading, it gave you a lot. It gives you a lot of the leverage, and then and also very simple. Okay, you basically just simple. You just buy. If you think it's going up, you just buy a call. If you think it's going down, you just buy a put. Okay, but the trade off is always like the win rate is relatively low. Okay, because of the in terms of the probability for the options going in the money or some or other things, unless you're really good at uh predicting the market. Okay, like you are really tuned, like every time you buy also goes up. Those kind of the people is very suitable. Your win rate could be very high. Okay, so like how to trade this strategy? Okay, of course you guys been following me for like almost half years, right? Okay, you guys know that when the first things is always underlying. Okay, underlines is selecting the underlines, you can like conduct your research because of the fundamental issues, or maybe like a technical and then macro environment, and then also you have to check the underlyings, the options liquidity, whether it's tight or narrow. These is the reason why you're picking up the underlyings. It could be like ETF, it could be stocks, like fundamental, maybe some of the earnings, or maybe like technical, because of the you're expecting you saw a centering triangle, and then you're expecting a breakout, and then macro also like favor your bullish, or maybe you favor your bearish. Those are the reason why you're picking up these stocks or ETF. Okay, and then once you have this kind of a view and you select your underlyings already, you will be having your directions, right? So that whether it's going up or going down, so that if it's going down, you just trade the call. If you're going down, if you're going up, you just trade the call. If you're expecting a breakout down to the downside, then you just trade put. Okay, simple. Okay, everyone. So everybody can follow, sir. Can you guys follow like these sections? Because I repeat these things like for every single chapter already. You know, it's very important. It is very important for you guys not to actually just look at the option chain and then don't know what to do. So this is the first step. Okay. So, and the third step is that you have to choose your aspirations, right? When you already have the directions, you look at the option chain, you still need to pick up your aspirations. Okay, if you are trading, often you guys you love to like 14 to 15, 14 to 40, 45 days. Some even much more lesser than 7 days, or even zero DTE. Okay, or even zero DTB, so that like it depends on what you're really looking at. Because like if you're expecting like the breakout could be happen within like 7 days, and then it will be slow bull, then it explode, then those kind of a shorter terms could be one of the cheaper way, lower down your barriers to actually entry to capitalize. But if let's say you are not sure, so yeah, but you think you will break out, maybe you want to go for like a longer expiration, longer expiration, because we already knows that the longer expirations, the slower the decay. The shorter one, the faster the decay is. Okay. So if let's say, assuming that you buy the call options, if let's say your options doesn't go in the money, having the intrinsic value to actually protecting the whole premium, beta's premium price, right? And then it went sideways. Likely, this kind of a trade, you'll be losing money. Okay, so that the time target is very important, and then also like because you're taking shorter period, of course your barriers of entry, your cost to entry is relatively low lah. But keep that in mind. If let's say it doesn't happen, the time decay is very fast, extremely fast. Okay, okay. So and also choose your strike price. Like some people, because they want the probably they want their options to actually, when it goes up, it immediately goes in the money, because like remember, like intrinsic value doesn't decay. Okay, remember that so that they want the intrinsic value immediately, so that the extrinsic value reduce. Eventually, like the majority of the portion is just like just intrinsic value. So you may just pick up the at the money, or maybe slightly out of the money. Okay, the but if let's say you choose slightly out of the money, then likely your options will be cheaper, but because it's further away from in the money, so that you have a much more lower probability for these options to going in the money compared to the in at the money. Okay, so another thing is that if you're long call or long put, right, you see I don't mention like in the money here, because like most people they just do here. But there's some traders, if they expecting the breakouts, right, they will also long in the money as well. Yeah, some people will just long in the money, but the in the money, as you guys know, that because it already got intrinsic value, so that it definitely much more expensive than at the money and out of the money. Okay, it will relatively expensive, but the delta is relatively high. Okay, the delta is relatively high. Okay, hold on a second. Okay, okay, all right. So the fifth one is the execution part. Okay, remember a lot of people they didn't check their orders. Like uh like when they actually buy the options, you actually buy it, right? But some people they don't check, because like they don't check whether they are tapping on the buy or sell. So they just simply like place the order. Make sure that because you're buying a call or buying a put, make sure that you buy. You click your order is buy, because this is very important. Some people they just want to buy instead of, but they didn't check. Instead of buy, they went in sell. Eventually it become a sell put or sell call. Okay, all right. And then also like the management part. The management part is the fast win. You just close your position, because if you're long call, if you don't plan to take the stock, you just want to capitalize the move. You just close the position by selling the contracts. Okay. And then one of the tips for you guys is do not hold for every last dollar. If you got the profit, you just take the profit. You hit your target already, just take the profit, and then you just move on. Okay. If the underlying move against you, okay, the value actually shrink, and then the data also like keep on draining your premium, you can actually like close your position early to limit your losses, or if let's say that it's almost like a max loss, you can actually hold through the expiration. You don't want to pay the commissions. You just hold through the expiration. You let it max loss. Okay, there are two ways to actually think about it. Okay, so like the example, so what is the example flow? Like for example, it's like S&P is at 500, and then you based on your chart maybe, or based on your macro, you think that the price will goes up, so that, and then you want more probability for the price to going in the money. You want to pay too much, but you want it like immediately got intrinsic value, so that you buy at the money, at the money strike call, like maybe expiring in 21 days. Okay, you think that within 21 days it will break out. And then you look at the premium, it will be costing you about like $4. Okay, it will costing you about $4. Hold on a second. Let me look at the chat. Okay, for those who asking question, because like I'm explaining on the slide, right? If I didn't address your questions, make sure you look at the chat box, because Option Hunter is helping me to actually address those questions. Okay, so make sure you guys check the inbox chat box there. We Option Hunter is addressing the question that you guys have raised. Okay. So where did I stop? Okay, here, like if let's say your premium cost is like $4, then you just, because one per contract is like 100, then likely you will be you have to times 100, so that your cost will be 400. So there will be two outcome. Okay, one is like within 5 days the price rally already like 2%, like, and then your premium elevated to from $4 to $11. So now you can sell it for $11. So your profit will be like 1,001 minus 400, then your profit will be 700. So that's a 175% return. Okay, with just like 2% both, if you're right. Okay, but if it doesn't rise, but instead the breakout fail already, maybe there's a fake out or something. The S&P like drops to like 490, and then hit your, and then maybe the premium goes down, and then maybe you already place your stop loss, or maybe you're not. The price was trading at 280, so you can actually close the position at 280. So what you lost is like $120. Sometimes like sometimes it can be max loss, like if let's say it dropped tremendously, or maybe you bought it when the IV is very high. Okay, so what's the risk and the rules? Okay, the risk and the rule is that always remember, when you long call, right, your enemy is always the time decay. Okay, your enemy is always the time decay. And then I hope you guys do remember I show you the decay chart, right? Like from like 120 days to 90 days to 45 days to 30 days to 15 days. How is the decay works, right? Can anyone still recall that the chart, the time decay chart? Can anyone still recall? Please comment in the chat box. Yes. Okay. So the shorter the time it is, the much more faster the time decay. It's good for seller. Every day you also like collecting, but it's not good for buyer, because like every day, it's just like draining your premium. Okay. And then the second one, the trap, is the IV crush. Okay, because we know that the volatility goes up, goes up, goes up, goes up, goes up, goes up. You bought at the high side, and then the IV goes down, so that because your extrinsic value will be going down, and then as the time passes by, you're also draining your premium. So that the IV also one of the things that you need to be aware. And then also that you have to accept the reality. I'm not saying everybody. I'm not saying everybody. I'm just saying that majority of the people is pretty bad at predicting the market. Okay. Even though, I mean, like, it's very hard to predict the market. I mean, no one does. Okay. But with some of the traders, right, they are with their due diligence, they do a lot of research, and then some of them's like a very great traders like also like make a record at 40% win rate, those kind of things. So that but when it wins, you wins by your R. Okay. Your R can be very high. For example, it's like one stock, you risk $1, then your return sometimes like $4, $5. That's about like 4R to 5R. Okay. So that even though your win rate is 40%, you still your expected EV still positive. You still can make money. Okay. So yeah, you have to accept it. If let's say you are doing a directional bet, unless like you really good like holy grail, if 60% of the time you're right about the direction, you only 40% lose. Wow, that one that one really holy grail already. Okay, so so that's the whole chapter actually. Like for you focus on the momentum, your long options like tends to underperform in the sideway market because the IV things and the data and things is your enemy, and then you really have to rely on one single directions. Okay, it's not like credit spread. You can even though the market sideway and move up or down depends on you whether you are bull put or bear call. You still can make money. You have to rely on one direction to actually win. Okay, and also like you have to consider the time factor. Okay, really important. Like the longer the time it is, the more expensive. But you have your decay is very relatively slower than the shorter expiration. And then also be aware of the out of the money trap because like the further away from the at the money will also means that you have a lower probability for the price to going in the money. Okay, it's cheap, but it's also having a lower probability of success unless that you're really good at like um betting the price it will be going up immediately. That's a different story. Okay, because sometimes out of the money, because of the gamma things, right, it can amplify the return as well. You know, right? So and then also plan your exit. Okay, always plan your exit. Okay, your exit could be your max loss. If let's say it doesn't work out, then the max loss I just let it expire worthless. Or maybe you only willing to lose half of the premium. For example, it's like you enter the long or call, your premium is at $4. You can put a stop loss like 50%, then you chow. You only lose $2. You always plan your exit when it doesn't works. Okay. Also, you have to manage your drawdown. Okay, because the uh many professionals actually avoid averaging down on the losing options. Okay, they actually prefer to close the position to preserve the capital. But if your premium already like 0.01 something, I don't think you need to bother. You need to be bothered to close up the position. You have to pay the commission some more. You just let it expire worthless. Generally, you would do that. Okay, and then yeah, so that's the chapter 9. It's very easy, right? Very easy, like like uh like the whole things is just when we went through like short push, short call, cover call, and then will and then debit spread, this kind of a thing. So the whole concept foundation is really much more easier for you. Much more easier for you now. So because you already got the foundation, when you look at this kind of the basic things, right, you tend to like, okay, the that's the basic. So what's what's the next things, right? You guys might be asking. Okay. So later, so that now I'm going to like go into my platform to show you guys what is the things that you need to be concerned. We are looking at the number perspective. Okay. So for those who haven't joined the follow our pages, this is the QR code. Make sure you guys scan the QR code to join follow us and then turn on the ring bell so that you can be you can be you can be updated whenever we have a live. So we cover the fundamental, some of the actionable strategy, platform tutorial, and some market relevant insight. Okay, this one will be like after that, after the whole basic dance. So I'm going to cover the platform now. So yeah, can you guys see my platform now? You guys can see my platform now, right? Algo trade. Sadly, algo trade is only available for stock now. But I think it's the what the options one coming soon. Okay, but not so fast lah. So fast. Okay, so like you guys give me a ticker. Give me a ticker, a random ticker, because a liquid one. So I just, because not for the sake of the analysis, I'm just like want to like show you guys on the option chain what you should be aware. Okay, not going to because I'm not giving any financial advice, right? I'm not allowed to. So like maybe I'll just do it myself. Okay, like maybe if you okay. Okay. So like as usual, it goes to the options. Usually what I love to actually adjust is that I love to like see my B and ask here, so that I adjust first. Let me adjust first, okay? Adjust first. Swing value, increasing value, IV. Then I love to see my delta here first. Then gamma, then data. So okay, done. So we have all the things that we want to see right here. First of all, like you guys like want to know like how to actually see the data. I mean, like sometimes Elwin always say like the data always the shorter time it is, the much more faster it decay. You have no idea what it how it actually like see from the numbers, right? Okay, I'll show you now. So I want you guys to focus a few things. Okay, first of all, we have different kind of the expirations here. Okay, from shorter to longer. We're going to focus like one here, one here, one here, one here. Okay, from shorter to longer. And I want you guys to focus on data. Okay, data. What it means by data? Data means that after a day gone, okay, after the day passed by, okay, how much is the your premium will be reduced. Okay, from zero we can see like to their expiration there's a 42. Okay, and then we see like maybe 39. Let's see, 39. The data decays will be like $2. Okay, 39. I think the 001 gives a calculation because the market ever open. But let's look at the 8 ones. Okay, the data is like $4. Okay, so that after today's, the likely the prices will be decayed by $4 theoretically. Okay, 36 day. Sorry, I should mention one strike price first. Let's look at 1035. Okay, let's still focus on this one. 1035. The data is like 4.3250. Okay, let's look at the one 1035. The data is like $1.80. Look at the 78 days. But this one doesn't have 1035. Let's take this one. Okay, take the at the money one. 1.18. Okay, 40. 0.7. Okay, can you guys see the longer expiration it is, the higher data or lower data? Comment in the chat box, please. Comment in the chat box. Lower. Yeah, it's lower. So the longer time it is, the much more slower it decay. This is what it meant. Like after today, the price of here will be likely to like reduce like 70 cents. But the shorter one it is like maybe like $2 or even $3. Some is like even $5. Let's see the 8 one. $4. Okay, and this one is much more crazy. Like this 0 DTE one. Can you imagine it's like if you long call at 0 DTE here? Kind of like crazy. And let's look at another one. Like, uh, this is 0 DTE, and then we look at 200. The data is like $2.50. Here, the data that is 0.3, further away 0.21. No, I think the 0 day got some calculation issue because the market haven't opened. But anyway, you can see. So this is how you actually look at it. And then, are we clear about this part? The longer expiration, how you actually see those data, whether it's how much decay every single day. If you guys clear, please type 1 in the chat box. Please type 1. Okay, I want to make sure you guys understand this. Because like some of these sessions, I do actually mention this many times before. So, okay, I'm seeing a lot of one. Okay, so this is the first thing. The second thing is that, okay, when so that now you guys the first thing I think is I clear out your questions already. How do I choose my expiration? What is the considerations we should put it so that you have to see like this kind of data, like 11 days, how much decay will be eating in your profit. If let's say you think that the breakouts will be happen within like 11 days, we also have to consider this. If let's say it only happens like after 4 days, how much is your decay will be eating? But can you actually visualize this thing? Yes, you can. Like 11 days, let's long a 200 strike here. And we look at the curve. After 4 days, right? 1, 2, 3, 4. If the price stay the same, likely I will be losing $74.55. Okay, $74.57. Okay, all right. This is how you actually see it theoretically. What is your potential profit and loss? You use the curve. Always use the curve. Okay. So that if you say you are not happy with this kind of the losses, then you may need to like adjust it just for a longer one, but you pay more. Your initial payout will be much more larger, like 1,004. Just now it's only like what, like few dollars. One, 1, 2, 3, 4. Okay, let's see. You see, this one after 4 days only lose like $31. Okay, you have longer time. Your decay is much more slower if the stock doesn't move a lot. Okay, focus on the current P&L, not the expirations. Okay, focus on the current P&L, not the expiration. Okay, so another thing is that you guys once you already have this factor, already have how to choose your expiration, you just like compare one by one, like which one is suit into your ideal risk profile. And then the second thing is that the strike price. Okay, some people ask how is this how do I choose the strike price? How do I choose that? Some people like in the money, some people are out of the money. How? Right? You might be asking this kind of questions, right? Okay. Before we even like choosing this strike price, I want you guys to actually focus on the data as well. On the data as well. Let's go from here, 200 and negative 0.1764. Okay. You guys can follow, right? Can follow type 1. Okay. Type 1, you can follow. Okay. Want you guys to actually can follow. Okay. I know there's a loss of number, but you guys just have to focus now. Okay. Just have to focus. Okay. All right. 0.1764. If we choose here, the data is much more lower. Let's see. lower, 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 getting lower, lower. So from the more deeper out of the money, the lower the theta. So let's see. Let's look at in the money. From here to here, okay, slightly higher, but it turns out to be lower, 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 lower. So it's like a bell curve, right? Low, high, low. Okay, low, high, low. Right, it's like a bell curve, right? Okay, so that what does it tells? What does it tells you? Okay, comment in the chat box. What does it tells you? It's a very obvious answer already. What does it tells you? Okay, what does it tells? Don't know. You should not buy in the 90 highest. Yes, yes. Only Rosum got it right. Okay, the highest, the at the money having the highest data. At the money having the highest data. Okay, and then, but if you see this thing, if it now it's like 197.58. If let's say it move like a few dollars more than 200, these prices having higher probability going in the money, right? Going in the money. So if it's going in the money, likely you already have intrinsic value. So this kind of value doesn't decay. Okay, this kind of value doesn't decay. You have a higher probability the price will go in the money. Then, and then, but with this kind of the probability, you have to be aware that at the money option, if the stock doesn't move, okay, every single day, you're likely to be decayed at the highest level. Okay. So that you have to be aware of this. You have to, if you have a 50-50 chance like go up or go down, but your data, if let's say it doesn't move, the market moves sideways, likely you will be suffering from the high data. And then the worst part is if every single day it stay the same, like maybe 22 days, like until 8 days, your data will be higher, you know. Your data will be higher. So that as the time pass by, you can see I guess when you guys actually focus on the purple one, it'll be higher, much more steeper, steeper, steeper. You know? Now it's like the steepest is like 0.2 something. If it doesn't move, 0.5. You can see that? So that you have to be aware of that. That's why when you long call at the money there, you have to make sure that you really time your target well. Okay. It has to be like breakout, it has to be a momentum. Okay? And then if you guys long here, much more cheaper but lower probability going in the monies, right? The price have to move like beyond 220. You only can have can have the in the money. But if let's say you're very good at betting on the prices, so that it move to here, you're making like 700 something. Then you close your position. It's up to you. Some people like capture from here to here, then they close the position. Why? Because another thing I want you guys to actually be aware that is that the bell curve not only happens on the theta, but also on the gamma. Okay. So what is gamma? Gamma is measures how much is the delta changes. So if let's say this it moved $1. I know that the delta this assume that 6.55, it will price will potentially increase about like 0.47. This is delta. But how much is the delta change? Delta cannot be static, right? So we look at gamma. Gamma is the how much the delta will be changed after the $1 changes the other line. so that you can see from low to high, and then from high to low. So some people just want to amplify from here. He know the NG will be lower, but he will just close the position. Some people do that, okay? But some people don't. Some people they just say that the momentum is still very strong. I just rely on the delta because like $1 changes I can make like 76, 80, 80, 80, 82, 87, something like that. It depends on you. Okay. So that depends on your strategy. But if let's say as the time pass by, the data is much more lower than the at the money. It's much more cheaper. But let's say within the time period, time frame, if it doesn't move in the money, then you're suffering from the decay as well. Because this out of the money option doesn't have intrinsic value. Okay. So this is the things that you need to be aware when you're choosing your strike. Then some people says that why don't I just like buy here? You can expensive for you got big price about 3,700. You see the spread is quite wide as well. The spread, the deeper money it goes, the much more wider the spread. But yet the money has is the most usually is the most liquid one. You see the spread is very relatively tight. A lot of people to participate here. And then another things why they actually want do from here to here because like the spread still relatively tight. When it went deeper in the monies, right? Deeper, like here you can see the spread relatively wide. But you make a lot lah, like $2 to here. So it depends on how your strategy and how you think about it. But how you actually simulate this thing, you always use the curve. Always use the curve. What is the potential profit you could be making if let's say after 10 days, which means 12 days left, 12 days left. It moved to like 214. How much you're expecting to be making? Like 900 something. But how much you are paying? 600. There's a quite a good profit. But if let's say it moved like only here, making 200, about like what 20 to 30%, then no. So this is how you actually simulate. Then you see like how is those delta, those gamma. You see the gamma, even though the gamma also the same. Gamma tell the same story. You see? At the money here highest, then this goes down. So this is like how you actually consider the risk factor you consider before you choosing your strike. Okay. Some people are like, oh, $1, if let's say it goes up, then I'm okay. But if let's say it go past by a few days after, yeah, I just let it expire. That's my max loss. Some people, I know it will goes up, and then I want more absolute value of the money, so that they just long at the money, and then they can make more. If let's say go to 214, right? It's not 214 is great. 214, likely they making more money. Like maybe like let's say 211. 211 824. Let's see here. 211. And if let's say I do like yeah, 211, let's compare. 300 something. This one I'm making 300 something. But 300% return lah, this one. But $300 profit. But just now that one is like about like what? 211. About 800. So the absolute value is very different. Immediately went in the money already, this part. Okay. So this is how you actually measure. You want the higher probability, more powerful delta, or you just want the relatively low cost, low probability, but you can you willing to accept this kind of the probability. Okay. And then the Vega things, right? You can see it's also the same. The Vega. The Vega is usually highest at here. If let's say you assume that the IV will goes up, this one will goes up with this value as well. The IV now is at 38%. So let's see the overall. The IV rank currently like percentile is like 57. Not high, not low. It's supposed to be 50-50. But in theory, if you're looking at the textbook, right, they will say like above 50 is already high. But But for some people, we'll just say it's still relatively neutral. Okay. Because you want to see those kind of high one, right? You can actually go here. But then you see how do I find this? Okay, let me see. Okay. Yes, and then earnings calendar. Let's see this kind of the near terms earnings one, the close to the earnings one. Let's see the option. 56, not quite low. Let's find another one. Unless the earnings season haven't. Let's see Netflix. 80% or 100%. You see, this one confirm is high, 100% already. So the IV about 75%, then the out of the money pricing in 104%. Let's see this one. The nearest earnings one. IV is 35, 37. See? Yeah. So when they see these kind of things, you have to factor in if let's say the IV drops down, what will happen? Because some people love to bet on the earnings, right? When after the earnings release, the IV crash, you can see. When IV overall the IV down, likely your options will be going down as well. Then your Vega will be reduce your premium. Okay. So this is how you actually look at the whole option chain by reading the Greeks, those kind of things. But because Moomoo is already having a very good features like this kind of tools, just use this one because you already factor in everything. You want to look at the delta, you want to look at data, those kind of thing, how many days pass. If let's say IV down, then if let's say IV down or up, will you making money? This kind of thing. Just use the curve. Just use the curve. Only when you do spread, right? When you do spread, when you do spread, then you have to be aware because your curve, your grids can change, can really change. Okay, like you do a bull call spread, and this one got a what? Got a positive data, but Vega, you see now is positive, but after that negative. So that when IV goes up, you will be losing money as well. But IV goes down, likely will be making more money. See, making more money because of Vega. Okay, this is how you actually simulate. So, yeah, so that's the whole sections about it. Like how you actually choose different expiration. You look at this thing, and then how you actually choose those kind of strike price, and then based on your personal risk profile to fit into your thesis. Then these are the things you need to be aware. It's the bell curve of the Vega, Theta, and Gamma. Okay, if let's say you want the absolute value, you want the delta high at the money or maybe slightly in the money, maybe. But if let's say you just want a low barrier entry and then you don't mind if let's say you break out, you make lesser absolute value, you here or maybe here you close your position, up to you. Up to you. Okay. So yeah, that's the whole sections about it. So yeah, I'll be looking at the chat box now. So hope you guys do enjoy it. Okay, you guys can follow about what I just said. I know the gamma things is a bit is where you guys might confuse. You just remembers that the gamma always highest here, and then lowest here, lower here, and then it just measures the changes of your delta. If you're long a call, okay, you wish your delta high or low. Just remember this, okay? You wish your delta high or low. Can anybody answer me? If you buy a call option, high, because $1 changes, it changes much more value in your premiums, right? For example, this one, you buy the options for $7.75. $1 changes, you can make you increase in 79. You see this kind of a deeper in the monies You move $1 here, you making like 96 cents. It's almost like 1 to 1 like a stock, when you're paying like relatively low premium, low initial capital compared to the stock. Almost like 1 to 1. Right? With this one move $1, you also move 96 cents. This is delta, you want higher delta. So that the more it move up, like for example, you long out of the money, the more it move up, you want the delta change more higher. So that's the concept. Okay. But also be aware that your data, okay, your data also high. And Vega also. Vega also be aware. Like, usually I'll just look at here first. Okay. If let's say IV very high, maybe you want to hedge it. Want to do spread 80 to 120. You cap lah. Maybe you cap. Yeah. Up to you. Okay. But if let's say you're expecting the IV will go down after, you think that it will gap up, the IV will go down. Okay. IV goes down, you're making more profit. For IV goes down, making more profit. Then you gap up here, $89. Not bad. But you cap lah, your profit, debit spread. So up to you. Okay. So you guys can follow, okay? You guys, it's not like normal long call, you just long call, long put, right? Some people thought that I'm going to like teach those kind of the if I bullish, I just long call. If I bearish, I just buy put. So today I'm going to teach you guys how to actually read all these things. But eventually, I just want you. I already tell you guys the logic, but eventually, you guys likely will be just using this thing and move around this thing, see how it change. Because eventually you just want to see like what is the potential of P&L changes. Okay, what is the potential P&L changes? Okay, all right. This is how you actually adjust your strike. If it depends on your different strategy. It's not like you long here, then you'll be aware of data. You long here, you'll be aware of the probability. If let's say your doesn't move in, you have a very low data, but like it's still consuming your premium lah. Okay. If you long here, your absolute value. Okay. Just use the curve. Okay. If you don't want to see all these numbers, just use your curve. Okay. See like after 4 days, so that if you guys don't want to bother about those kind of Greek things, right? Because this already help you to calculate it. After 4 days, only rise to this price. What is the potential P&L? If let's say after a few more days, if it stay the same, how much I'll be losing? If let's say it goes down, how much I'll be likely losing? If let's say IV goes up a lot, then will I making money? Okay, right? There is no gut feel, is it? Seems like all the move is calculated. You still have to like conduct the analysis, like the underlyings, like whether your technical analysis or maybe your fundamental or maybe like your macroeconomic analysis, like is it like favor in your direction? Those kind of things like still based on your decision. If let's say you are talking about this thing, like how much is the option price is pricing in now? Yeah, that's the expected move. Okay. But in option, you are right about another things is that if you're doing if you are doing like spread, you thinking another way. Okay. If like how much is the probability for this option going in the money? If let's say you have you think that it won't likely go above 81, then you collect the full premium, $20. Then your probability having a different perspective. That one I already cover on the credit spread. If you haven't watched it, make sure you go and watch it. Okay, that one is a lot of things can be calculated actually. Like if you are going to that kind of the probability things. of course, like if you're asking me whether I can do like technical analysis also when I long the call, I want to know that whether how much is the probability. Can I be like quantify all these things? Yes, you can. Okay, you can backtest it. If you guys don't know how to backtest it, you guys want me to show you how to backtest to generate signal and see whether your thesis is correct or not. If you guys want, tap one because I got already 9 o'clock. Okay, yes sir. You guys don't let go me. I hope you guys say no. Okay, right. Okay, so you guys are actually like can see like there is a discover here. You guys maybe realize there's an algo here. There's an algo things here. Okay, last times when you want to create a strategies, right? You have three ways. One is canvas. One is either you know how to fight on. One is another thing is canvas, like you playing the card. Like you maybe want to add a card like MA, those kind of thing. If MA like this, then like this, those kind of things. Nowadays, because of AI, right? You don't have to do these things. Like for example, like uh you can do like long condition. Say for example, okay, you need to prompt first. Help me create a strategy on canvas. Okay, long condition. When RSI below 30, then go long. Exit condition. When RSI above 60, then exit position. Okay. And entry position 50%. Okay. Example lah. Example. You type yes. Let's see, does it work or not? Let's see. So that you will analyze my request, those kind of things. Creating strategy, understand the things, and then evaluating the condition, combining the condition, you know, this kind of thing. Okay, generating strategy. I hope it works. Okay, yeah, I do these things before. Yeah, I do a lot of things before. Even write Chinese on it. This strategy aim to enter when you check your rules. Okay, entry like that, 50% available position. Then you see the box here. Then you click. You click. Yeah. I'm not sure whether is it lagging or what. But right, you should be able to click. Am I lagging or something? Yeah. Hey, how come cannot one? Maybe I need to restart, is it? Better can one. Maybe I delete this one. Okay, then let me see. I cannot like double click. Is it? Let's see. How come cannot type one? Is it I didn't update? Let me close out my other things. Okay, let me close out. See. Okay. Let me restart my things, okay? Let me do it again, okay? I'm not sure. I think got bug. Maybe like I should update or something. Update. But before that, okay, you guys understand what I'm doing right now, right? Second, okay, okay, let me see. Okay, couldn't see you guys. Hold on. Yeah, okay, let's go back. This is what. No, no, no. I'll go. Ah, because of lagging. Yeah. Okay. Just now we got prompt already, right? New. Okay, it will become like that, and then new strategy. Okay, you will pop up here. It will pop up here. Okay, you check your position 50%, those kind of thing. Okay, and then you backtest. Okay, when you backtest, right, then you can select your things like Nvidia. Yeah, maybe you SP1. You want to test on SP1? Okay, maybe test two stock first lah. Then how long we want to test? Like maybe we test for the sake of fast since the beginning until 1st of July lah. Then I only have like 10,000 next. So what time frame I want to run? Maybe I run on one daily time frame. Daily time frame. Next. Review run. So that you will run the strategy. So you will see like whether your long condition or short condition does it make money or let's see. Just now what like when the RSI below 30 I long. When above 60 I out. Okay, let's see. Only got one signal only. One here long, here short, here exit. Only one signal only. This one didn't trigger. Surprise. And this one didn't trigger because the RSI is still like 30 something, then 50 something. Didn't trigger. Okay. You can test a lot of different stock. Then you can backtest. So this is how you verify your strategy. If you want to backtest whether your strategy works or not, then you can use this strategy. Like like if you want to make a strategy much more complicated, then you check. You can say like long condition where what you the prompt first. Help me create an algo strategy algo long condition when price above MA 50 and RSI below 30, then go long. Exit when exit condition. Exit when RSI above 70. So you prompt, you wait the AI run and run. But sadly, you cannot test on the option strategy because like this one only on stock. But at least you can, from a technical perspective, you can actually see backtest your this kind of indicator whether it works or not. Then it may or may not be your signal to entry. So sometimes like this kind of entry, right? Maybe you will be as an option trader, then how you want to do it. There's a signal here. When the price goes down, it hit your condition already. You are very disciplined one. So what you do? Usually you want to ride on your trend, right? Buy, right? You're bullish. So when you're bullish, then what you want to do because the price comes down already, then is your IV high or maybe IV low? If let's say if your IV high, then maybe you want to become a seller. Then you do credit like a bull put spread here. You do a bull put spread here. Then the expiration depends on you lah. Like here, does it have holding period? I don't think have holding period here. But if you can find the holding period better lah, like average holding period maybe like 5 to 6 days. Then this one like how long? 1, 2, 3, 4, 5, 6, 7, 7. Then maybe you short 14 days, 30 days. Up to you. Okay. Then short like bull put spread or maybe bull call spread or maybe just long call, up to you. Because like when IV high, then likely you want to become a seller, right? Become a seller where because like when premium high, because like when you revert, you as a seller you collect your premium faster. So this is how you think about it when the signal come out already. How you want to do long call, bull call spread or bull put spread, or maybe you want to do a long calendar or something. That one I haven't teach, but not planning to teach in the near future as well. That one. But yeah, let's see my AI. Is it done already? Done already. Let's see. If let's say above these things, I only do above this. You can actually choose from watch list. Like maybe I do a lot like this one. What is this? Maybe earnings. I don't know what it is, but I'll just test it. Okay, just test. Uh, millions lah. Let's say we have a millions August TSMC this thing. The bad thing is that every time I have to like adjust like daily time frame. Just daily time frame. Hold on, give me some time. Not sure whether can prompt like hey, it will run. It will run. It will take some time, so it will take some time. But because I only run 1 year, should be very fast to get the whether this strategy like works or not. Let's see. 65. Okay. Are you guys still there? Are you guys still there? Oh, you guys left already. Oh, you're still there today. Okay. Okay. Yeah, let's see. Run. Even trigger condition. Too strict already, is it? Ah, so strict. Didn't trigger even a single one. Is it because of all the stock is below 50 MA? Maybe I edit. When RSI below 40 and this one above 20, maybe 20. Okay, let's see. Did I adjust? Yeah, 20 and 4. Hey, is this one 20? 20 already. This one 40, correct. Let's test again. Lucky I don't need to adjust one by one. See. Run. Didn't trigger. Got signal already. Wow. Okay, got buy. Okay, got this one buy. Maybe bull push spread this one. Don't call this one. This one bull call spread. But this one not option by the way, not option. Just stop. Just simply stop. This one got one signal. Okay. Making money already finally. Wow, draw down so long. This strategy. And then it flat. Break even already. Even worse than my FD. Worse than the cash plus. This one. So this strategy not really good. Less signal and then draw down some more. Is this a good strategy? Is this a good strategy? Is it good for you or like is it good or not? Okay, you found out that you found a losing strategy already. You think good or not? Not good. Okay. Anyone else? Good or bad? This strategy? Not good. Okay. Okay. You come from a tool perspective. The strategy is yes, it's losing, it's not good. Do you feel sad or happy? Okay. My question should be accurate more. Do you feel sad or happy? Okay. Anyone interact with me? Like sad or happy? Okay. Sad or happy? Right. Sad. Loss. Okay. All right. So my answer is actually very simple only. For me, it's a good thing because like this is backtest. Imagine you found out that this data, will you still trade it with the real money? If you don't have this data, do you think that if you use the real money to actually trade this thing, you will be losing money, draw down, then you break even, you're making a little bit. So that because I backtest already, I see this curve. Actually, you think from another perspective, you are happy because before you're using the real money to test this, to place your real money to place on this trade, you know that it won't work. So that you avoided a loss of the losses. You already find out it won't work. Okay? This is what the data will tell you. Okay, this is the one of a very important piece of the back test. Uh, you can actually do verify. Okay, so for me, it's happy because I don't have to use my real money to trade this. You suffer like hell, bro. Yeah. Imagine you this is like 50% capital already, but draw down less lah. That's a trade. No point. So if your guys are asking me like, am I have any a loss of this kind of model to running? Yes, I have like 30 to 40 model running. But yeah, but last time lah, last time. But because now only do this thing. But yeah, you can test, like I test lots already. Like almost like more than 300 strategy I tested. Only a few is like workable one. Right. So I hope you guys do enjoy the sessions. Like it's time's up already, okay? And then hope you guys do enjoy it. And then yeah, the long call, long put, like when you actually do options, make sure you actually like check at the money, out of the money, or in the money. Okay. If you don't know how to see these things, you just care about like how is your P&L change. Make sure you go to the curve, working around with the time after few hours or yeah, get a better example. This one, maybe like after a few days, 1, 2, 3, 4, 5, 6 days, only break out to this level, we're all still making money. We're still making money. We're still making money. If let's say after 2 more days, we're still making money, no. Okay. If let's say IV down, IV up, yeah, that's it. Okay. All right. So like we still have one more sessions to go. Okay, which is the management thing because but that one is like nothing much to actually to uh mention. But so it will be a very short session as well. But I'll use that time to actually chit chat with you guys. But yeah, okay. Hope you guys do enjoy it, and then make sure you guys like when is the time? Move fast. Yeah, move fast. Make sure you guys pay a visit to meet Alwyn because Alwyn will be there to meet you guys. Okay, make sure you guys meet up. I hope you guys can have a little chit chat there. He's a very nice guy. Usually he will be wearing a blue suit one. Okay, a very blue suit. If let's say not blue suit, then you black jacket like a Jensen Huang one. Okay. Right. Make sure you guys meet the Malaysian version Jensen Huang. Okay. All right. So I'll see you guys next time. Okay. It's getting late already. I consider my extra time for you guys already. Okay. I have to do my things. Okay. All right. I'll see you guys next time. Thank you. Goodbye. And then no financial advice. All the things I said is just for education purpose. Goodbye.